How will coronavirus impact financial statements for annual and interim periods ending 31 January 2020 onwards? The impact of the coronavirus or COVID-19 would largely be disclosed as a non-adjusting subsequent event in 31 December 2019 financial statements. However, when we look at periods ending on 31 January 2020 onwards, the rule of thumb would be that COVID-19 will impact amounts recognized in financial statements. However, as events evolve over the next few months, it may sometimes be difficult to determine whether changing facts and circumstances should be incorporated when measuring transactions and balances at reporting date, or whether disclosures as a non-adjusting subsequent event is appropriate. In our newsletter article, we include an example. In this example, Beauty Parlour has a 31 January 2020 year end. Business continued as usual until social distancing rules were introduced during March. Now, Beauty Parlour was forced to close on 24 March 2020. Now, in its 31 January 2020 financial statements, the impact of COVID-19 is likely to be limited to disclosure as a non-adjusting subsequent event because at 31 January 2020, it is unlikely that the operations of Beauty Parlour would have been impacted by COVID-19. However, if Beauty Parlour's reporting date was 31 March, the mandatory shutdown on 24 March would result in assumptions about COVID-19 being incorporated into the measurement of transactions and balances at 31 March 2020. We discussed the impacts of COVID-19 on interim financial statements, and we discuss it under three headings: measurement, disclosure, and also the fact that goodwill impairment cannot be reversed. If we look at the impact on interim financial statements and in particular the impact on measurements, we note that for entities preparing interim financial statements for the 6 months ended 30 June 2020, the effects of COVID-19 are most likely to be apparent, and revised forecast and projections will be incorporated when measuring asset values. If we continue our discussion on the impacts on interim financial statements and now focus on disclosures, we note that disclosures about the impacts of COVID-19 on an entity's transactions and balances during the interim period need to be comprehensive. That is more than what we would usually see in times when it is business as usual. Where measurement has been impacted, for example, impairment of non-financial assets, preparers should be looking to the disclosure requirements in the relevant accounting standard, and in this case, it would be IAS 36, impairment of assets. Finally, we look at the reversal or the fact that goodwill impairment cannot be reversed in future. Now, we know that when we look at impairment testing for goodwill, we have to assess impairment triggers at each reporting date. But there's also a requirement to perform an annual impairment test for goodwill. Now, this means that goodwill could potentially be tested for impairment more than once a year. For example, an entity with a December year-end may have performed the annual impairment test for goodwill on 31 December 2019 with no COVID-19 impacts. However, at the interim reporting date, 30 June 2020, goodwill must be tested for impairment again because of the COVID-19 impairment trigger. Impairment losses recognized on assets such as property, plant, and equipment and identifiable intangible assets are permitted to be reversed in subsequent reporting periods. This is not the case for goodwill. Impairment losses recognized against goodwill in one period cannot be reversed in another. IFRIC 10, Interim Financial Reporting and Impairment, states that no such reversal may occur for goodwill because IAS 36 does not permit an impairment recorded against the value of goodwill to be reversed.